Money is shifting. For months, liquidity inside the crypto markets looked stagnant, but now the tide is flowing into Ethereum. Institutions in the US are buying relentlessly, hundreds of millions in inflows every single week, signaling that Wall Street has chosen its blockchain. The spotlight is no longer only on Bitcoin. Ethereum has been elevated in a way few expected, especially after the SEC granted approval for Ethereum ETFs. I personally thought Bitcoin would stand alone with that kind of recognition. Instead, Ethereum joined the list, legitimized on the same institutional level. Ethereum isn't the fastest chain, and it's not the cheapest. But the genius of its design is that Layer 2 networks solve those weaknesses. The base layer remains the anchor, and every credible project still chooses Ethereum as its foundation. Look no further than Coinbase's base chain. When the biggest US exchange builds, it builds on Ethereum. This pattern repeats across DeFi, across tokenization pilots, across every serious corner of the industry. Financial analyst Tom Lee has been one of the strongest voices explaining why Ethereum can dominate this cycle. His view isn't based on hype, but on fundamentals. Ethereum is evolving into the global settlement layer for tokenized finance. The Ethereum 2.0 upgrade, combined with Layer 2 scaling and the Dencun hard fork, has drastically lowered fees and boosted efficiency. Staking yields create a steady demand loop, and ETFs have created a regulated gateway for institutional capital to flow in at scale. Lee also highlights Ethereum's role as the bridge between TradFi and DeFi. Tokenization of real-world assets, from bonds to equities, is happening where compliance, liquidity, and developer power meet. That place is Ethereum. Banks, asset managers, and fintechs are already piloting tokenized instruments, and nearly all of them are choosing Ethereum as the settlement layer. With this backdrop, my own prediction becomes clear. Institutions aren't speculating, they are allocating. Ethereum is positioning itself as the vehicle to connect Wall Street with the crypto economy. And the way liquidity is moving, the price path ahead is defined by three possible scenarios. As momentum builds, the question everyone asks is where Ethereum could realistically trade this cycle. The range of outcomes is wide, but the structure is clear. In the bear case, Ethereum reaches between $7,000 and $9,000 per coin in the following months. That alone would mark a historic repricing of its value. In the mid case, Ethereum trades in the $10,000 to $13,000 range. This feels like the most realistic outcome, fueled by sustained institutional inflows, tokenization adoption, and the natural ETH/BTC ratio reversion. In the bull case, Ethereum pushes to $14,000 to $20,000. It's ambitious, but if we see a liquidity surge under potential QE conditions and institutions double down, the door is open. Personally, I lean toward the mid-case scenario. Ethereum at $10,000 to $13,000 reflects the fundamentals, the adoption curve, and the flows we're already witnessing. Still, when institutions step in, they rarely play small. That's why the bull case cannot be dismissed. Institutional interest, regulatory clarity, and Ethereum's unmatched role in bridging TradFi with DeFi are laying the foundation for the next great move in crypto. Wealth is built when conviction meets opportunity, and Ethereum today is that opportunity. Dr. Money Glitcher.